Kraken filed 56 million tax forms, 74% for transactions. Under $50 Kraken filed 56 million crypto tax forms with the IRS for the 2025 tax year, and the bulk of them cover pocket change. According to an insight posted by CoinDesk on April 22, 2026, one-third of the filings reported transactions under $1, and 74% were under $50. The number is a direct read on what the new broker reporting regime is producing at scale, not a projection. One exchange, one tax year, 56 million individual forms hitting the IRS mailroom. Why Kraken is submitting this volume? The 1099-DA reporting requirement for digital asset brokers took effect starting with the 2025 tax year. Every US-based exchange now has to file a form for each gross proceeds event on a customer account, with no minimum dollar threshold. A stablecoin swap, a trailing buy of a microcap token, a fractional Bitcoin sell. Each one generates a line item that eventually becomes a form. Kraken, as one of the larger US-facing spot and derivatives venues, sits at the top of the volume stack alongside Coinbase and a handful of other regulated brokers. The 56 million figure reflects what happens when you apply a universal reporting rule to an asset class where users routinely make dozens of microtransactions a week. For context, the brokerage industry as a whole files roughly 1.6 billion 1099 forms across all categories in a typical year. Kraken alone, adding 56 million from one product line, is a meaningful new load on IRS processing systems, and it is only one exchange's contribution. The sub-dollar problem, the detail that stands out is the size distribution. A third of the forms cover transactions under $1. Most of those likely represent dust swaps, rebalancing trades inside structured products, failed or partial fills, and routine liquidity rotation in stablecoin pairs. They are not wealth events. They are not even taxable gains in any meaningful economic sense once fees are subtracted. Yet each one generates a form, and each form generates a cost for Kraken to produce it, for the IRS to process it, and for the individual user, who has to reconcile it against their own records at tax time. A user who traded actively across a year can end up with thousands of lines on their own return, most of which net out to a few dollars either way. The practical effect for US crypto users is a compliance drag that scales with activity, not with income. Someone who bought $500 of Bitcoin and held it all year gets one or two forms. Someone who used an exchange as a routine liquidity venue, swapping into stablecoins and back across a payroll paycheck-by-paycheck dollar-cost average plan, can end up with hundreds. The IRS treats both the same way at the reporting level. What this changes for active US traders. The reporting burden falls mostly on the end user, because the broker form is only half the tax return. The other half is the matching record on the user's own 8949, which requires cost basis, acquisition date, and disposal date for every single transaction. If the numbers do not match the 1099 DA, the IRS gets a mismatch flag and can send a notice. A few things follow. First, the economics of high-frequency retail crypto trading on US-regulated exchanges now include a real accounting cost. Tax software that handles crypto has been around for years, but the pricing tiers almost always scale by transaction count. 56 million forms across Kraken's user base means average per-user transaction counts are high enough that mid-tier tax software plans will often not cover a full year. Second, stablecoin use as a cash equivalent inside an exchange account is not cost-free from a reporting standpoint. Every swap between USDC and USDT, or between a stablecoin and fiat, is a separate taxable event with its own line. The IRS does not currently recognize a de minimis exemption for small crypto transactions, despite years of lobbying from industry groups. Third, US-based users who want to reduce their form count have a narrow set of options. Hold for longer periods, consolidate trades into fewer larger orders, or move activity to venues that are not US-regulated brokers and therefore do not file 1099 DAs. The last option has its own tax consequences because the reporting obligation does not disappear, it just moves back onto the user's own records. The policy question. The 56 million figure lands in the middle of an active debate about whether Congress should add a de minimis threshold for small crypto transactions. Bills have been introduced in past sessions to exempt trades under $200 or $600 from reporting on the argument that the compliance cost exceeds the tax collected. The Kraken data is the clearest public evidence yet that the current rule captures enormous volumes of transactions that generate no meaningful tax. Whether that argument moves any votes is a different question. The counterargument has been that a threshold creates avoidance opportunities, with users structuring trades to stay below the line. The size distribution in the Kraken filing suggests most sub-$50 transactions are not strategic avoidance at all. They are just what retail crypto trading looks like when the fee unit is fractional and the underlying asset is divisible to 8 decimal places. For now, the forms go out. For users holding through a Kraken card or spending from exchange balances, the rule applies to every conversion that funds a purchase, not just the trades a user thinks of as investments.